In September 2025, Oracle's stock hit an all-time high of $345 per share. Fast forward just 3 months, and the stock has crashed 46%, erasing $160 billion in market value. But here's what most investors are missing. The bond market is absolutely screaming that Oracle could be in serious trouble. Credit default swaps, which is the insurance contracts betting against Oracle going bankrupt, just hit levels not seen since 2008 financial crisis. We're talking about up to 15% probability that Oracle defaults or restructures its massive debt in the next 5 years. And the CEO just admitted it by doing something companies only do when they're desperate. He's asking customers to bring their own chips and is now allowing suppliers to lease equipment instead of Oracle buying it outright. This is not normal. This is financial distress disguised as innovation. We're going to break it down and tell you exactly what you need to know, so stay tuned. Welcome back to StockScope Live. I'm your host, and if you've seen my video on Oracle back in September, you saw we were already flagging concerns. But what's happened in the last 90 days has accelerated those concerns into a full-blown financial crisis. Here's the timeline. In September 2025, Oracle successfully raised $18 billion in bonds. The market loved them. Credit default swaps were priced around 60 basis points, basically saying Oracle is rock solid. Investors were piling in. Then something shifted. By November, Oracle reported earnings, and the number looked good. Revenue was up 13%, cloud infrastructure was growing 66%, and they reported a monster backlog of $523 billion. That's 8.3 times their annual revenue. This should have been a celebration. Instead, the stock started cracking. Then, on December 10th, just 5 days ago, Oracle reported Q2 earnings and management dropped a bomb. They are increasing capital expenditure guidance from $35 billion to $50 billion for the next fiscal year. That's a 43% increase halfway through the year. The bond market's response was swift and brutal. The credit default swaps exploded from around 70 basis points in October to 148 basis points today. That's a 110% increase in the insurance cost of Oracle's debt in just 6 weeks. And we need to talk about what that actually means, because it's painting a picture of a company in serious financial trouble. I'm going to walk you through 4 critical reasons why the market has turned on Oracle so violently, and why the bond market is probably right to be concerned. Let's start with the fundamental problem: cash flow. If you're not paying attention to free cash flow, you're not analyzing a capital-intensive business correctly. And Oracle is now the most capital-intensive company in the entire cloud infrastructure space. Here's some actual numbers from Oracle's financial statements. In Q4 of fiscal 2025, that's basically May 2025, just 6 months ago, Oracle burned through $2.92 billion in free cash flow in a single quarter. That means operating cash flow was $6.16 billion, but capital expenditure was $9.08 billion. They spent more than they made. But here's where it gets scary. By Q2 of fiscal 2026, which is November 2025, Oracle's free cash flow deteriorated to negative $10 billion in a single quarter. In just 1 quarter, operating cash flow collapsed to $2.1 billion, while Capex exploded to $12 billion. Let me put that in perspective. Oracle is now burning $10 billion per quarter in cash. At that rate, the company will exhaust its entire $11.2 billion cash balance in just 13 months, absent any debt raises. And look at the trajectory over 4 quarters. In Q1, their FCF positive was basically $5.1 billion. In Q2, the free cash flow was negative $2.7 billion. Q3, free cash flow was basically flat. Q4, the free cash flow is negative $2.9 billion. And Q2 of fiscal year 2026, their free cash flow was negative $10 billion. Yeah, you got to see the pattern there. Capital expenditure is accelerating exponentially, while operating cash flow is collapsing. This is the definition of an unsustainable business model. Now, Wall Street analysts have been modeling that Oracle's Capex would peak around 35 to 40 billion and then stabilize as the company matures its infrastructure. Instead, Oracle just said it's 50 billion for next fiscal year, and there's no visibility to when it stops increasing. Here's the math the bond market is doing. If Oracle is burning 40 billion per quarter on negative free cash flow, which is where it's headed at current trajectory, and the company only generates 20 to 25 billion in annual operating cash flow, then Oracle needs to borrow approximately 15 to 20 billion every single quarter just to keep the lights on. That's a 60 to 80 billion per year in new debt just to fund an unsustainable Capex program. Oracle's current debt is 104 billion. The company is talking about needing to raise capital substantially less than 100 billion over the next 3 to 4 years, thanks to their new BYOC, or bring your own chip strategy. But the math doesn't work. At current burn rates, they'll need 60 to 80 billion just in fiscal year 2026 to 2027. The bond market is correctly pricing the fact that this is unsustainable. And when a company can't sustain its business model, default risk skyrockets. Now, let's talk about what the bond market is actually telling us, because this is where things get really, really scary. The credit default swaps, also known as CDS, are essentially insurance contracts. When you buy a CDS on any debt, you're betting that that company will default or restructure its debt. The more expensive the CDS, the higher the perceived default risk. So here's the timeline for Oracle's CDS spread over the last 90 days. In late September, it was at 60 basis points. The bond raise was successful. Investors thought Oracle was fine. In late October, it went up to 70 basis points because investors started to have second thoughts. By mid-November, it went up to 95 basis points because concerns were building up. By December 5th, it was at 128 basis points. And here's the critical detail. 128 basis points is the highest level Oracle CDS has hit since March 2009, in the depth of the financial crisis. We're talking about Oracle hitting financial crisis levels of default risk in December 2025. That's not a technical fluctuation. That's a fundamental reassessment of solvency. Then December 12th happened, where it went up to 145 basis points. And then today, December 15th, it went up to 148 basis points. That's a 147% increase in default insurance in just 75 days. So what does 148 basis points actually mean? Here's how credit analysts translate this. It means the market is pricing a 9 to 15% cumulative probability that Oracle will either default on its debt, be forced into a debt restructuring, have its equity wiped out, or face some other credit event within the next 5 years. To put that in perspective, NVIDIA's CDS is trading around 37 basis points. Apple of all companies, is around 40 basis points. Amazon is around 30 basis points. Oracle is trading at 4 times the default risk of its largest customer, NVIDIA. Now here's what's really, really concerning. The bonds themselves are also falling apart. The 18 billion in bonds Oracle issued in late September, just 2.5 months ago, are now trading at massive discounts. Investors have lost approximately 1.35 billion in paper losses on positions purchased just 75 days ago. The 5-year bond are selling at a 5% discount. The 30-year bond, the ones maturing in 2055, are selling at 11.5% discount. That's telling you everything you need to know about what bond investors think of Oracle's long-term viability. Morgan Stanley's credit team just published a note saying that Oracle CDS could reach 150 to 200 basis points if Oracle doesn't provide financial clarity. At those levels, we're looking at a 12 to 15% default probability, which approaches the levels we saw for actual bankrupt or restructuring companies during 2008-2009 financial crisis. And here's the vicious cycle that's forming. As Oracle CDS spreads widen, it becomes more expensive for the company to raise new debt. If Oracle tries to issue new bonds at current spreads, they'd be paying 6, maybe 8% interest instead of the 3 to 4% they paid in September. Every $10 billion in new debt just became $200 million more expensive per year. And that's just in interest costs. At a 50 to 70 billion annual Capex requirement, that's an additional 1 to 1.4 billion per year in interest expenses Oracle now has to pay. That eats directly into free cash flow and makes the spiral even worse. Now let's talk about something that's slightly funny if you have a good sense of humor. In December 10th earnings call, Oracle management did something that caught a lot of people off guard. I actually couldn't believe they did it. They announced a new strategy to fund the data center build-out. Instead of Oracle buying all the AI chips, the NVIDIA H100s and H200s, customers can now bring their own chips to Oracle data centers. It's like when you used to go to parties and you had to bring your own beer. This is being positioned as a competitive advantage. The pitch is, we're so confident in our infrastructure that customers don't need us to buy the chips. They can bring their own. We will just provide the world-class data center, power, cooling, and networking. Sounds great, right? Except the market, the bond market specifically, immediately understood what this actually means. Oracle cannot afford to buy the chips itself. Here's the brutal reality. A single NVIDIA H200 GPU costs approximately $40,000. To build out the AI capacity Oracle has committed to building, the company needs to purchase or lease approximately 96,000 or more GPUs just to fulfill their immediate backlog. That's $3.8 billion in GPU costs alone per quarter. Oracle's operating cash flow is only $2 to $6 billion per quarter. If the company had to self-fund GPU purchases on top of all the other data center expenses, real estate, power, cooling, networking, integration, Oracle would have negative free cash flow of 10 to 15 billion per quarter, which is exactly what they're experiencing. So in comes the BYOC strategy. Now, Oracle says customers can buy their own chips. We'll just provide the infrastructure and charge them per hour of GPU usage without the chip markup. So what's the problem? Let me paint the scenario. Meta has committed to a massive Capex budget to power AI model training. They pre-fund or pre-commit billions to Oracle's infrastructure. Oracle builds the data center in Abilene, Texas, or wherever. Meta buys NVIDIA chips and installs them. Now, Oracle's Capex burden is reduced because Meta funded the GPU portion. Oracle's cash flow looks better. The bond market calms down. Everyone wins. Until Meta decides AI Capex is getting too expensive, or training efficiency improves enough that they don't need as much compute. So what happens then? Meta reduces their footprint. Oracle has excess data center capacity that isn't generating revenue. The Capex that was funded by customer prepayment is now an asset with no corresponding revenue stream. And Oracle's cash flow collapses again. This is actually correlated risk. When Oracle's customers get into financial trouble, Oracle gets into financial trouble at the same time. You lose both revenue and the customer-funded Capex support. And there's a second BYOC variant. Suppliers like NVIDIA and AMD now lease chips to Oracle instead of selling them outright. Oracle pays less lease fees, presumably aligned with customer revenue. Again, sounds good. It reduces upfront Capex, but what if customers reduce GPU demand? Then Oracle is locked into lease agreements it can't afford, with no corresponding revenue stream. Management is trying to frame this as innovation and flexibility. What the bond market sees is a company desperately trying to reduce its capex burden because the debt load is unsustainable. Now, I'm not saying the BYOC strategy is definitely going to fail, but I am saying that when a company that was supposed to self-fund a 35 to 50 billion annual capex suddenly pivots to having customers and suppliers fund infrastructure, it is a sign of financial stress. The bond market is correct to be concerned. Now, a lot of people ask, but wait, isn't Oracle 523 billion backlog a massive positive? And yes, in theory, it is. But let's dig into what actually is in that backlog and whether it's real. The 523 billion remaining performance obligations is the largest in Oracle's history. It grew 433% year over year, and that's enormous. But, and it's a big but, and this is critical, approximately 40% of that backlog, 209 billion-ish, is expected to convert to revenue within just 12 months. That means Oracle is contractually obligated to deliver 209 billion worth of cloud infrastructure services in the next year. To deliver that, in infrastructure services, Oracle needs to A, complete data center construction on schedule, install, operationalize 96,000 plus GPU units, connect them all with cutting-edge networking, power and cooling running 24/7, provision customers on schedule, not have any capacity go unused. That's a Herculean operation challenge. And Bloomberg reported in December that Oracle is already facing delays on data center completion dates. Think about what happens if Oracle misses delivery timelines by even one quarter. Revenue that was supposed to flow in Q1 fiscal year 2027 gets pushed to Q2. Customer frustration increases. They're paying for capacity they can't use yet. Some customers might reduce or cancel orders. The revenue backlog evaporates faster than expected, but the capex is already spent. The data centers are built. They don't disappear. Free cash flow remains negative. Bond spreads widen further, and the stock declines further. This is the downside tail risk that the bond market is pricing in. And here's another problem. Oracle's operating cash flow is only 2 to 6 billion per quarter. But to service the debt, pay interest, and maintain operations while waiting for that 209 billion to convert to a cash, Oracle needs continuous refinancing. If any major customer like Meta, NVIDIA, OpenAI reduces their capex or extends their payment term by, let's say, 30, 60 days, Oracle's cash flow gets squeezed. The company then needs to refinance faster or tap credit lines. The bond market knows this. They know Oracle is now operating on razor-thin cash margins with a massive operational delivery obligation. One miss, 1 quarter of delays, one customer reduction, and the cash flow picture deteriorates materially. The 525 billion or the 523 billion backlog is only valuable if Oracle can, 1, deliver on time, collect cash from customers, 2, and 3, service existing debt. You miss any of those 3, and the backlog becomes a liability instead of an asset. So where does this go from here? Well, there are a few scenarios playing out in real time, and I'm going to give you several, 4 to be exact. Scenario 1, Oracle executes flawlessly. This has about a 30% probability. And in this case, the company delivers all data center capacity on schedule, customers prepay as committed, and the 523 billion backlog converts to cash exactly as modeled. The capex peaks at 50 billion and then normalizes. Free cash flow turns positive by fiscal 2027. The bond market calms down. CDS spreads compress back to 60 to 80 basis points. The stock recovers to 250 to 300. Oracle becomes the unquestionable winner in AI infrastructure. Scenario 2, there's modest delays and customer slowdown, 35% probability. Oracle faces 2 to 3 quarter delays on major data center projections. or projects. Customers like Meta or XAI reduce Capex commitment by 20 to 30%. Revenue backlog converts more slowly. Capex doesn't decline as fast as expected. Free cash flow remains negative through fiscal 2027. Bond spread widened to 170 to maybe about 200 basis points. And Moody's and S&P initiate downgrade procedures. Stock crashes to 120 to 150. Oracle avoids defaults, but faces severe financial stress. Scenario 3, credit crunch and forced restructuring. About a 25% probability. If private credit markets seize up, if customers materially reduce Capex, or if any recession hits, Oracle faces a situation where it can't refinance maturing debt at affordable rates. The company is forced to negotiate with creditors for debt restructuring. Shareholders get heavily diluted. CDS spread blow out to 250 plus basis points. The stock crashes below $100. It's not a bankruptcy, but it is super ugly. And the last scenario, we'll call the black swan, around 10% probability, some external shock, severe recession, AI training efficiency breakthrough eliminating Capex needs, or major customer bankruptcy creates a cascade. Oracle is forced into bankruptcy or severe distress restructuring. Debt holders lose 35 cents on the dollar. Stock goes to zero. It's 2008 all over again. The bond market is currently pricing scenario 2, 3, and 4 at roughly 85 to 90% combined probability. They're giving scenario 1 only 10 to 15% odds. That's an 85 to 90% bear case embedded in the CDS spreads. Whether or not you agree with those odds, that's what sophisticated credit investors think. Here's the bottom line. Oracle is no longer a safe AI infrastructure investment. It's a leveraged bet on an unsustainable Capex cycle. The company is burning $10 billion per quarter in free cash. The debt load is $104 billion and growing. The bond market is pricing a 9 to 15% default risk. And management just signaled it can't self-fund its Capex by shifting to customer and supplier-funded infrastructure. Now, this doesn't mean Oracle is bankrupt tomorrow. It means the margin for error is gone. Execution has to be perfect. Customers have to stay committed. Debt has to be refinanceable at reasonable rates. And the broader economy must stay healthy. Any of those assumptions breaking causes a cascade effect. Now the stock is down 46% from its September peak. There's a chance it bounces if Oracle delivers a surprise win, or if the Fed aggressively supports debt markets. But the structural issues aren't going away. If you own Oracle stock, you need to honestly assess whether you believe the company executes flawlessly and the bond market is being irrationally pessimistic. Because right now, the two are completely disconnected. Stock investors think Oracle is a growth winner. Bond investors think Oracle is a default risk. Someone is wrong. The bond market has usually been right in these kinds of situations. Here's what I want you to do. Subscribe if you found this analysis valuable. Drop a comment below. Do you think Oracle executes its Capex plan or faces restructuring? Share this video with people that are in the market, especially Oracle shareholders that you might know. The bond market is screaming a warning. Make sure people hear it. Thanks for watching. Stay diversified, stay safe, and I'll catch you in the next video.